will come in and we'll get started here in just a second. All right, we're live on Facebook. So good afternoon.
Awesome.
I'm Paul Markle, the Executive Director of the Barrie Chamber of Commerce. And I'd like to thank you for joining us today for this TD Economist update. Before we begin, I'd like to start with a land acknowledgement. So in keeping with Indigenous protocol and building respectful relationships between Indigenous and non-Indigenous peoples in Canada, it's customary to acknowledge the traditional territories and ancestral lands of the Indigenous peoples. The Barrie Chamber of Commerce acknowledges the sacred land on which we operate. It's been the site of human activity for 15,000 years. This land is the ancestral land of the Wendat and the Anishinaabe Nation. The treaties that were signed for this particular piece of land are the Williams Treaty, Robinson's Barrier Treaty number 60, the Penetanguishene Purchase number 5, and the Nottawasaga Purchase number 18. We're dedicated to honoring Indigenous history and culture, and we also recognize the enduring presence of Indigenous peoples on this land. So we're committed to moving forward in a spirit of reconciliation and respect. Miigwech. So today, the economic outlook has fluctuated significantly throughout the pandemic, and as we continue to look forward towards recovery, many of us have questions about what to expect in the coming months. And now we have an opportunity to be best prepared by listening to our guest economist from Toronto Dominion Bank. And before we get to that, if you have questions, we'd like you to put those questions into the Q&A and not into the chat. And you can find that right at the bottom of your screen. Once the presentation is done, we'll get back to moderating those questions. But to begin, I'd like to introduce Mike Grube, who is the Area Manager for Small Business Banking, TD Canada Trust. Mike is a great guy, fantastic person all around, and a great friend to the Chamber, and has been able to arrange this today for us. So we're grateful to have you here, and Mike's going to introduce our economist today. So with that, Mike, take her away.
That's great, Paul. Thanks very much. And the check's in the mail for all those kind words, for sure. Certainly wanted to give a shout out to Paul and Julie and the whole staff at the Barrie Chamber. The work that they've done over the past 18 months has been just awesome, supporting businesses in our market. So a real great shout out to the Barrie Chamber, and all the work they've done certainly has been pretty awesome. So, on behalf of TD and my account managers in our area, we certainly wanted to give a shout out and admiration to all of our business owners who have shown just incredible perseverance and dedication and commitment over the past 18 months. Some of these businesses, how they've adapted and pivoted, and gotten so creative in terms of changing their business model to adapt through what we're going through. So a real great shout out, just so impressive to see what's happened in our community, especially. So we also did want to say thank you to our existing our clients, TD clients. Just thank you for all your support. We did want to say that we are lending. We're seeing incredible growth as businesses continue and really do start to invest in their own businesses in our market. We're lending. We're open for business, which is a great news story as well. So thank you to all of our clients. And at this time, why everybody is here, it's really my pleasure to introduce Rishi Sondhi from TD Economics. We have a pleasure of listening to today. And Rishi joined the economics team in 2017. His main responsibilities include analyzing and forecasting provincial economies and housing markets. Rishi, prior to joining TD Economics, he worked at a real estate consulting firm where he researched and forecasted provincial and municipal economic activity as well as housing market. He also has experience with the Bank of Canada, the Ontario Construction Secretariat, CMHC, and other major financial institutions. In that later role, he forecasted the economic performance of both the US and Canadian economies. He holds an honors BA degree in economics from the University of Western Ontario. And without further ado, I turn it over to Rishi.
Oh, thank you so much, Mike. And now I'm going to share my screen. Can everybody see my screen? I'm assuming yes. Okay, yeah. Great.
You just got to hit from the beginning and you're good to go.
Okay, great. Thanks, everybody. All right, wonderful. So again, thanks, Mike. thanks for Paul for having me on this afternoon to discuss Ontario's sort of economic situation. Now, before I get into my little my little talk here, I just want to say three things. First of all, I want to apologize for doing this presentation from my basement, but unfortunately, my personal situation is such that had to be the case. Second thing is that my family actually moved to Barrie in 2009, so I'm familiar with the city. My dad lives off of Mapleview Drive there. And finally, I thought I would open with a bit of a joke this afternoon in honor of the Leafs preseason starting up. So when I pass away, I want the Maple Leafs to bury me so they can let me down one more time. And he laughs. I hope so. So with that out of the way, I'll move forward with my presentation. So I'll start with the U.S. economy, and this is of course important because the U.S. is our biggest trading partner. And the big thing about the U.S. is that it's outperformed during the pandemic, not only Canada but other G7 countries. So less of a decline in economic activity in 2020 in the U.S. and stronger growth this year in the U.S. So it's a pretty positive story in that regard for our largest trading partner. So what's been the largest contributors to growth in the U.S.? Well, it's really been consumer spending and non-residential investment and a fairly hot housing market, similar to what we've seen in Canada, which is stimulated growth this year. So next year, we're expecting growth to slow a little bit in the U.S., but still remain pretty strong, driven by consumer spending. So let's bring it back to Canada now and look across the provinces. So when you look at 2021 and 2022 overall, it's a fairly solid growth story across all provinces. 2021 is really a bit of a rebound from really weak activities in 2020, and 2022 represents a continuation of that rebound. So in 2021, we expect when it's all said and done for BC and Quebec to have led the way in terms of economic growth, whereas Ontario will be a bit of a laggard. Now in 2022, we expect the script to be flipped and that Ontario will lead the way in terms of economic growth, while some of the other provinces lag. So looking across the provinces, we expect elevated oil prices to stimulate increased oil production next year, which will boost economic growth in Alberta, Saskatchewan, and in Newfoundland and Labrador. In BC, non-residential construction should support growth, whereas in Quebec, robust government spending should do the trick. In Manitoba, its diversified economy should be boosted by its manufacturing sector. And if you look at the Atlantic provinces, there's not, relatively softer growth expected in this region. But we got to remember that the pandemic wasn't as severe in these provinces than it was, in other places in Canada. So there's less of a hole for them to sort of dig themselves out of. So let's dig deep into Ontario now. So next year, we expect economic growth in Ontario to be led by the high-touch services industries. We also expect decent growth in manufacturing, a bit of a recovery in manufacturing, as well as some decent growth in retail as well. So what do I mean by high-touch industries? Well, this is restaurants, gyms, fitness centers, casinos, amusement parks, hair salons, barbershops, places that were closed during the pandemic, during sort of the worst of the pandemic, and suffered a very severe decline in output in 2020 and 2021. We expect the combination of high vaccination rates and policies such as vaccine passports to help keep the virus at bay, such that these industries can remain open and recoup lost output. Now, with respect to the manufacturing sector, this is really a function of our assumption that the semiconductor shortages that are currently plaguing the industry and causing output to likely decline this year should diminish as next year progresses, such that auto production sort of normalizes towards the end of next year. And that lift from automotive production should support overall manufacturing activity in Ontario, given its importance in Ontario's manufacturing industry. The retail sector should be lifted by factors that I'll talk about in a moment. The professional, scientific, and technical services industry captures IT. So IT services, and the like. So this has, of course, been an extremely high demand during the pandemic, owing to work from home and businesses transitioning their business models or building out their website presence and so on and so forth. So we expect another strong year next year in this industry. The public sector, represents sort of government spending, and we do expect growth to sort of moderate a little bit in the public sector after a very strong year this year, and this is a function of assumptions that were embedded in the latest provincial budget. But I will say that the fiscal backdrop for the provincial government is much, much better than what they thought when they initially drew up the budgets. When they initially drew up the budget, they thought the deficit was going to be 38.5 billion last year. It was only 16.4 billion. So that may give them some wiggle room to sort of push spending a little bit higher, and that could boost output in the sector. Fire represents finance, insurance, and real estate. So 2020 was a pretty strong year for this industry in Ontario, driven by a hot housing market. But now that housing market activity is coming off the boil, we expect output growth to moderate in the sector. Other services, just some of the other sort of small services industries. And the last industry I'll call out is construction. So construction made a huge contribution to economic growth this year. And why is that? That's because housing demand was extremely robust during the pandemic, which has raised prices and generated a supply response. But now that housing demand is cooling, we'd expect supply to also come off the boil as well, and that'll weigh on overall construction output. So I'd mentioned that retail output and indeed overall household spending, well, retail output should make an important contribution to growth, but so should overall household spending. So why do we think that's the case? Well, the jobs market in Ontario is recovering, so that'll support incomes. And we think further economic growth next year will support job growth. Also, households are sitting on a pretty big pile of savings in Ontario. So what happened during the pandemic is that there were some of these forced savings that were imposed on households in Ontario. So because services industries were shut down, you couldn't travel, go to a restaurant and the like, you couldn't spend that money. So it kind of forced you to save some of that money. So households are sitting on a pretty good pile of savings from which they can use to sort of finance consumption moving forward. An important part of the consumption story pertains, or the household spending story pertains to what households are spending on. So through the course of the pandemic, much of the spending was concentrated on goods, and that's because the services industries were locked down. So instead of spending at restaurants, people were buying or traveling, people were buying like exercise bikes and tablets and stuff to renovate their homes and the like. So now that these high touch industries have reopened, this spending is orienting itself, reorganizing itself or moving itself towards the services sector and away from the goods sector to some extent. And that's important because, as we know, there's supply chain issues being faced by Ontario's manufacturers. But it's not only Ontario's manufacturers, it's also Canada's manufacturers, and manufacturers globally are really in a big competition for input materials to produce the goods that they produce, right? And a function of that is the fact that demand for goods has been so strong. So if demand for goods comes off the boil a little bit, that should reduce pressure on these supply chains to deliver these goods. So that's an important rotation that's taking place. Speaking of supply chain issues, as I mentioned before, we expect auto production to normalize sort of in the second half of next year. So the semiconductor shortage should ease as we move forward. Let's turn now to housing market activity, which is always an important topic and an interesting topic when I give these presentations. So in the second half of 2020 and the first half of this year, Ontario's housing market is absolutely on fire. Home sales were much, much stronger, or running at a much stronger clip than any other time in the history of the data. So it was just an absolutely on fire market. But the thing with that is that, you can only run sales at those levels for so long. That level of activity was just unsustainable, and indeed, we've seen home sales come down across Ontario in the second quarter and indeed in the third quarter. So looking ahead to 2022, we expect a healthy level of home sales to take place, so healthy housing demand, albeit not as elevated as we saw during sort of the supercharged year that was 2021. So what are some factors that will support housing? Well, one, we expect mortgage rates to remain relatively low. Two, we expect further economic growth. Three, we expect population growth to pick up. And four, as I mentioned before, households are sitting on mountains of savings, some of which will flow into down payments. Now, with respect to prices, again, 2021 was a very, very strong year in terms of price growth. 20+% year-on-year price growth is expected when it's all said and done this year, which is just absolutely humongous. So next year, we're not expecting the same amount of price growth. We expect prices to kind of grind slowly higher as the year progresses. So not as strong price growth, but an elevated price level. So what's going to support this elevated price level? Well, it's due to the fact that housing markets are quite tight from a supply and demand perspective. There's just not that much supply out there to satisfy demand. So let's talk about what's going on in Barrie's housing market now. So if you look at the chart on the left, it shows home sales and the average home price, year-over-year growth in the average home price in Barrie. So like the broader province, home sales have come off the boil quite significantly in Barrie, and that's taken some of the steam away from average price growth. That said, average prices are still growing at a very, very strong rate, 26%, up 26% year on year in August, which is down from over 40% in March, but still very, very extremely strong. So what's supporting this extremely strong pace of home price growth? Well, like the broader province, markets are quite tight from a supply-demand perspective. There's not that much supply to satisfy demand. That's one thing. Second thing is Barrie's, of course, a commuter city. It's a nice place to live. And even though home prices have risen quite markedly in the past year, Barrie's housing is still relatively inexpensive compared to other jurisdictions like York Region and Toronto. So, people are still willing to pay those prices to come live here. The chart on the right shows, well, I guess my right, shows building permits, the value split between residential and non-residential for Barrie. And as we can see during the pandemic, there's been a boom in home building in Barrie, and this is a function of the fact that housing demand has been very strong and prices have been elevated and supply response has been triggered. And again, as housing demand comes off the boil or it is coming off the boil in Barrie, that should cause a bit of a pullback in residential construction. Non-residential permits have ticked higher in recent months, and that's a function of commercial investment. Turning now to employment in Barrie. Employment is recovering, but it still has a ways to go. So as of August, the 3-month moving average of employment in Barrie is about 8% below its pre-pandemic level. So again, still a ways to go to recoup some jobs lost during the pandemic. When you look at the performance by industry, the real laggard here is the finance, insurance, and real estate sector. I mentioned the housing market is cooling, so perhaps that's reducing demand there. It's not that much of a surprise that the transportation industry would be struggling from an output employment perspective, because the pandemic, hit the transportation sector. Administration and building support services like janitorial services, for example, in support of office buildings, and given work from home and a delayed return to office, there's likely less demand for those services. Other services is like barbershops, hair salons, and other personal services that were closed during the pandemic. So again, there's no surprise that employment is lagging there. Employment is lagging a little bit in some of the other public sector industries, also in accommodation and food services, which is basically restaurants. Looking at sort of the opposite end of the coin, employment has done well in professional, scientific, and technical services, which again is a function of robust demand for IT. It's also done well for construction because home building has been very strong. It's also done well in retail and wholesale trade, and that's a function of reopening. And it's also held up relatively well in manufacturing. I would say almost surprisingly well in manufacturing, and also information, culture, and recreation, which is a mishmash of several industries like motion picture production and data processing and the like. So we've talked about the U.S., we've talked about Ontario, and we've talked about Barrie. Let's talk about some of the risks to our forecast for economic growth there. Of course, the biggest risk is the pandemic. We're not quite sure how it's going to evolve. Hospitalizations remain relatively low in Canada compared to other jurisdictions. But the thing is that Canada doesn't have the same hospital capacity as some of these other places do. So it takes less of an increase in hospitalizations for reopening rollbacks and lockdowns and the like to be triggered in Canada relative to these other jurisdictions. That's an important point to make, I think. Another important risk from the outlook stems from the fact that Ontario's economy is more levered to international supply chains than the rest of Canada is. So we're at the mercy of other countries' production capabilities, which are being strained at the moment. So that could supply a bigger hit to growth or last longer. These supply chain issues could last longer than what we're anticipating in our forecast. Another big impediment for economic growth, we think, is labor shortages. So this table shows the latest CFIB survey of businesses. So basically, they survey small, medium-sized businesses across the country, and they ask them, a variety of questions, including, what are some factors that are impeding your ability to conduct business? And far and away, the biggest issue facing businesses, according to the CFIB survey, is labor shortages, with 86% of businesses reporting this as an obstacle as of August. So huge issue here. Now, when you look across industries, the labor shortages in Ontario seem to be most prevalent in accommodation and food services. So, restaurants, again, are having trouble attracting workers. Administration and waste, so like janitorial services. Construction, that industry always seems to have a difficulty, attracting workers. Health and social services, we've all heard sort of the anecdotal stories about nurses quitting and the like. Manufacturing and retail also look like they're struggling to find workers. On the opposite end of the spectrum, you have transportation and warehousing, for example. Not so surprising that there wouldn't be a labor shortage there, because demand is so soft in that particular sector. On the other hand, demand is quite strong in professional, scientific, and technical services, but also labor supply is solid there too. So not much of a shortage going on there, at least according to StatsCan's latest survey on this stuff. So we know that there's labor shortages. The question becomes why? Well, in our view, there's a few factors. First of all, there's government benefit programs, which, in some cases, perhaps in the case of the CERB and the first iteration of the CFRB, have, provided equal to or more income than some workers were earning, when in their prior job. So it's, generous government supports. Second thing might be virus fears. People might be afraid to go back to those restaurants because, the virus is still prevalent. And finally, and important to us, we think that, people are not necessarily wanting to return to their prior industry. So what may have happened during the pandemic is that, people were laid off or whatever it is, and they took that time to sort of reassess their situation and say, do I even want to return that industry? Maybe they don't. Maybe they're making another decision, a career decision. So, they've done some reskilling and now they're re-entering the labor market. But in those situations, it takes time, for employers and employees to match in that situation. So let's talk about the U.S. experience. I think the U.S. provides a bit of a useful blueprint in this regard, because the U.S. opened a few months before us. The U.S. opened in about March or so. We opened in about June, July-ish, right? So they're a few months ahead of us on reopening, and they too are struggling with labor shortages for many of the same reasons that we are here. So the important thing is, the big question is the situation improving in the U.S.? And unfortunately, it doesn't look like it. So they reopened in March, and we have data to July. So March, April, May, June, July. So that's 5 months. So in 5 months, has the situation improved? It doesn't. Again, it doesn't look like it. If anything, it's gotten a little bit worse, unfortunately. Now, one interesting thing about the U.S. is that they too have generous federal government support programs, but half of the states chose to opt out of these federal government programs early, and the other half chose to sort of stay for the entire duration out to Labor Day. So, again, half of those states opted out and half of the states stayed in. So that gives us an interesting opportunity to compare job market outcomes for these two groups, just to kind of see what happens. So for those states that opted out of the federal government, benefit programs early, there was an uptick in labor force participation relative to the group that stayed for the entire duration, which and you'd expect, given you're not getting that government income anymore, so you need to sort of start looking for a job. The other thing that was observed is that consumption dropped, which of course again makes sense because you're not getting that government income. But what's interesting is that employment wasn't different between the group that opted out early and that group that stayed longer. So employment outcomes weren't that different, which to us means that again, people aren't just going back to the industries they were at before. They're taking more time. Maybe they've reskilled or whatever. They're taking more time and perhaps moving to different industries. And again, it takes time for that employee mismatch or a match to sort of take place. So what do we think for Canada? Well, if the U.S. is any template, we're in for labor shortages for at least the next several months, unfortunately. And what we've formally incorporated into our forecast is that we think that these will persist through much of next year, but diminish, such that by the end of next year, this situation would have largely worked itself out. And so why do we think that? Well, we think that because, population growth, we expect to sort of pick up next year, again, as high vaccination rates and, policies such as vaccine passports keep the virus at bay and allow the population to pick up, allow borders to remain open and population to pick up. So let's look at our forecast for commodities. So the chart on the left shows our forecast for crude oil prices, and we think oil prices will largely hold at current levels. And this is a function of two things. First of all, demand should be robust as economic growth across the world continues to recover. However, we do think that this rise in demand will be matched by an increase in supply by the U.S. and OPEC. The U.S., of course, is the largest producer of oil in the world. The chart on the right shows our forecast for copper prices, but this could be any metal, could be silver, gold, aluminum, whatever the case may be. It could also be some food prices, wheat, etc. So what happened this year is that there was this big run up in all these commodities as demand was very strong and supply couldn't keep up as quickly. But now these prices have started to come off the boil, and we think they'll continue to normalize next year, but remain at elevated levels. So, of course, commodity prices have important implications for inflation. Inflation has emerged as a topic du jour. Why? Because it's run extremely hot. The Canadian inflation rate was 4.1% or so, I believe, in August, which is the strongest or the fastest rate since 2003. So inflation has reemerged as an issue. So what are some of the causes of this inflation, we think? Well, one of the most important causes stems from what economists call base effects. So what are base effects? Well, when you measure inflation, you measure the price level in a given year compared to the price level in the same month in the prior year. So what happened during the first wave of the pandemic is that prices fell in March and April of last year, and they remained depressed for several months. So what we're doing now is we're comparing the price level this year to these depressed prices last year, and that's almost artificially boosting the inflation rate to some degree. So that's one factor. The second factor is gasoline prices have risen quite substantially this year after falling in 2020 as oil has rebounded. Third factor is that there's been reopenings, and as reopenings have occurred, there's been an increase in demand for travel services. So rental car prices have gone up, airline ticket prices have gone up, and hotel accommodation prices have gone up. And then finally, we have these supply chain issues. Again, so because manufacturers in Ontario, Canada, and across the world are having difficulties securing input materials to produce what they need to produce, those costs have increased. So the costs for manufacturers have gone up, and they're pushing that on into consumer prices. So moving forward, we think that overall inflation will remain elevated for several quarters now, remaining above 3% for the next few quarters, but ultimately by the end of next year we think it'll settle in at around the 2% range or so. So some near-term persistence in overall inflation, but it should trend lower. Now, core inflation is a bit of a different story, I'd say. Core inflation subtracts off some of the more volatile components like energy and food prices, and here we expect inflation pressures to be relatively persistent going forward, and that's a function of input shortages and robust demand. So the underlying inflation backdrop should be more inflationary than what we saw prior to the pandemic, again because of input shortages and healthy demand. So against this backdrop, what's the central bank to do? Well, we think the Bank of Canada is going to raise their interest rates starting in the fourth quarter of next year. So why the fourth quarter of next year, and why not something earlier, given elevated inflation and strong economic growth? Well, that's because there's slack in the economy. So when the Bank of Canada gets together and they talk about what they're going to do with interest rates, they want to assess the amount of slack in the economy. So what do I mean by that? Well, the Bank of Canada estimates how much the economy could potentially be producing and looks at what it's actually producing. And if there's a gap there, then they don't want to move on interest rates. So they're not going to move on interest rates until that gap gets closed, which in their estimation and our estimation won't happen until the second half of next year. So once that gap is closed, then they'll start moving on interest rates. So what's our forecast for the dollar? Well, we don't expect much of the way of movement in the dollar. We expect it to hold, generally where it's been for most of 2021. Perhaps some modest depreciation, sort of in the early part of 2022, as U.S. economic growth is stronger than Canada's, and that's supportive for the U.S. dollar vis-a-vis the Canadian dollar. However, we think that that'll sort of reverse a little bit sort of towards the end of 2022 as the Bank of Canada starts to raise interest rates, and that puts a modest upward pressure on the dollar there. But overall, not much change in the dollar in 2022 relative to 2021, perhaps down a cent or so on average. So as we know, there was recently a federal election. There's a Liberal minority now, which means that they basically just have to get the NDP on side to push forth their policies, which should be doable in some respects, because the NDP wanted to spend even more than the Liberals did on their campaign trail. So a few interesting things from the Liberal platform is that we think, if the Liberal platform were to be enacted, as it was sort of set out, then that would boost economic growth next year and in 2023 before turning into a bit of a drag in 2024. So that's one interesting thing we pulled out. Second interesting thing we pulled out is that, the Liberals have this whole wide array of housing initiatives in their platform, but we think that, that's much ado about nothing, or sound and fury signifying nothing. We don't think their housing platform will move the dial much with respect to sales and prices if it were to be implemented. And another interesting thing that we sort of pulled out from the budget is that the Liberal government plans to extend the Canada Recovery Hiring Program out to March 2022 from its current estimated end date of November 2021, and they're also pledging significant support for the tourism industry. So that wraps it up for me. Thank you so much for listening to me, and I'd be happy to answer questions that you may have.
Sorry about that. My phone rang at the moment you were finishing up there. But thank you very much, Rishi. That was very interesting. I was writing a bunch of notes in here, and most of what you were talking about was way above my head. So I'll bring this down to a common guy speak kind of thing. And there's a number of questions in here, but I thought I'd throw an interesting one at you right off the hop, which is a simple question: are we headed for a recession?
No, I don't think so. I think we're not going to. Yeah, no, I don't think so. I mean, the biggest risk to our outlook, I would say, is the virus. But the thing is that Ontario's economy, Canada's economy, economies around the world have become increasingly resilient to the virus. So even if there's another fifth wave or sixth wave, or the case may be, the economies become more resilient, which reduces the risk of recession. So that's one thing. Second thing is that if the virus were to sort of take hold more aggressively, then the Bank of Canada would probably delay raising any interest rates. So that monetary stimulus and that fiscal stimulus would probably remain for even longer, and perhaps could even amplify. So I think if the virus sort of took off a little bit more, which could be a catalyst for recession, that could put some pressure on the Liberal Party to extend some of the programs that they have right now, right? So in their platform, there was no discussion about the CRB or anything like that, right? But if there was a fifth wave, then that might be something that's on the table. They're under pressure to do that anyways. So long story short, I don't think that we're heading for a recession. Our baseline forecast assumes pretty strong growth next year as the supply chain pressures sort of ease, and labor shortage issues ease as well.
Well, that's good to hear. I mean, there's a number of questions in here with regards to interest rates. We can just stay on that for just a second or two, but it's good. I mean, I would hate to think that the government is going to, cut off these things when you're, 10 feet from the shoreline, because I mean, all we're hearing, constantly is what are we going to do if they start cutting these things out? One of the questions I had in here with regards to, the productivity gap, with jobs, I found it interesting that job participation in the States is increasing, but employment stays the same. What's the answer there? I mean, how long are we expecting that maybe it's the skills gap closing is going to create this kind of a problem? Because I see that as being, especially in our area, a massive issue, and it ties to housing as well.
Oh, sure. Definitely. It ties into construction, the construction industry looking for workers and the like. But, again, I think the U.S. experience is quite instructive. They've been struggling for labor shortages for at least 5 months, likely 6 months now. And so there's really no end in sight in that regard, at least in the short term. Right. So, I don't think the U.S. is different than us in that their vaccination rates are lower. So that means that there's probably more virus fears there than there are here, but there's still some virus fears here, I think. So there are some differences between the two countries, but there's a lot of similarities. So given that the U.S. is struggling through this labor shortage issue, I think that's going to be in the cards for Canada and of course Ontario for some time. Our formal forecast again sort of embeds an easing in these issues. They can't last forever, quite frankly, right? I mean, people aren't gonna stay unemployed for 2 or 3 years or whatever. They're eventually going to do something, whether it's go to school or go back to their old job if they can't find a new one, whatever the case may be, or maybe the virus will, vaccination rates will keep even higher, whatever, right? Some way, shape, or form, it'll sort itself out. And again, in our formal forecast, we assume by the end of next year, the second half of next year, stuff would have sorted itself out. A big thing that we think is that population growth is going to pick up next year, and I think that's going to help ease some of these labor shortage issues that we're seeing. So that'll be helpful in that front. And one thing about comparing Canada to the U.S., one thing about Canada is that we're more friendly with respect to encouraging newcomers into our country than the U.S. is, even with Biden versus Trump. So that's just sort of the way it's been in Canada for the past several years. So I think we're going to make a push to get more people into the country. In fact, Quebec is notoriously like a province that doesn't, they're kind of more stringent with respect to their, who they let into the country. Even them, they're sort of making allowances to allow more population growth into the province. So in order to deal with the labor shortages that they're seeing there. So I think that'll be helpful in alleviating the issue, but it'll be with us for a while.
Okay, and that's a great response. Mike, have you got any questions? I'm looking at you and I'm thinking I'm hogging the stage, but you probably have some questions in a feel for what's going on locally as well. What's on your mind?
Well, no, I think I'm just reading through some of the questions in the chat. I think those are some great questions that people have from locally, but some really good information there. And I think, wherever we're seeing, especially with our clients, we're seeing these help wanted signs everywhere, right? So I think that is an issue that every and not just specific to one industry, every industry is having, whether the businesses were struggling or even now they're taking off, right? So, I think the immigration, and I think I had heard that we're on pace as a country to actually accept more immigrants this past year than ever before, on a per capita, even during the pandemic. So that, as Rishi had said, that could certainly help some of that labor shortages, right?
And we're hearing the same thing from Immigration Council. Unfortunately, you don't have really solid numbers because the last ones I think were in 2016. So I mean, really, the census data there, I think it was a little skewed as well. So I think the numbers were higher from a baseline standpoint, and be interesting to see what happens with the next one. But certainly, we're hearing that from our manufacturing sector as well, that they're going outwards to look and bring people in on the whole, bring in high tech, bring their family to cover off some of those lower skilled jobs, and that would help us immensely. So very, very important. Childcare access issues are still having a big impact on labor and workforce. Does the childcare subsidy model need to be adjusted to balance this out?
Well, I mean, they're trying to do that. I mean, the Liberals are they have the $10 a day daycare in their platform, which of course would be affordable daycare for everybody. So that would obviously be helpful in that regard. The interesting thing about that is that I'll talk about that for a little bit. So that's been a dream of the Liberal Party since at least the 90s to get affordable daycare, and it's sort of always been blocked by other parties that for whatever reason, right? But 7 of 10 provinces have signed agreements with the federal government for this. And, the NDP is on board with it as well. And of course, the NDP is the party that the Liberals need to get on board with to push their policies through. So, there may be some momentum here. We may be, having an opportunity to get some affordable childcare moving forward. So that's helpful. But the big thing that'll help on childcare front and, in terms of then boosting labor supply is keeping the virus at bay, right? So there's been, through the pandemic, there's been more closures on a per capita basis for schools in the U.S. than there has been in Canada. And why is that? That's because the pandemic has been worse, right? So if we can keep the virus at bay, then schools can remain open and people can go to work. So that's really the big thing. So vaccination rates are obviously extremely important. Canada's does extremely well in that regard. Although we're not the tippy top of the leaderboard. There's countries like Portugal and some other countries that have done a little bit better, but we have pretty high vaccination rate, which so that's good. So I think that's the real key to making sure that childcare, like daycares remain open and people can go to work. One last thing I'll say is that with respect to affordable childcare, Quebec has had it for many years now, and they have a pretty high labor force participation rate for women. Quality, affordable childcare has allowed women in Quebec to sort of join the labor force at a greater rate, and Quebec's labor force participation rate for women is higher than the rest of the country because of that policy.
And I think that's a very important point. I mean, we know that the most highly impacted sector of our world is our females, and you know, and some attention needs. So that's actually a good point. Along the same lines, I'm going to throw out the big nasty word, universal income. Opinions on that? And do you think that that would have you know, an impact on the labor issues as well?
Yes, I do to an extent. I mean, it depends on the level that they set it at. I mean, to draw sort of an analog, right? Like the CRB and the CERB were pretty darn generous. So that, you know, and in some instances, we know this to be true. In some instances, like the data will tell you that, you know, people were making more with CRB than they were in their old job, right? So, you know, when you have that going on, what's the incentive to go back to your old work, right? So that's, you know, so if they set, sort of a basic income at a pretty elevated level or at a high level, then that could cause the same issue. So it really depends on what they, you know, what they set it at, that level. If they set it low, it shouldn't be that that troublesome. But you know, there's some risk there depending on what they do. I mean, I guess if it was, you know, in sort of an NDP world, you know, that basic income would be, well, their EI is about $2,000. Like they would want $2,000 a month, so maybe they'd want something like that, right? Which would be pretty generous, I think.
Yeah, and I would tend to agree with you. Continuing that doesn't help anybody in the long run. Switch gears a little bit to, there's a question here with regards to post-secondary education, that the sector is showing big increases due to reskilling and people shifting careers. Will this impact some sectors more than others down the road? What's your outlook on that?
Yeah, sure. So there's a move towards digitalization and automation, right? So that's been a long-standing trend as sort of the world has become more automated, and that's really just been accelerated by the pandemic, right? So those jobs in that type of industry we think will be, you know, there's a future there, right? And then some other industries, they're already sort of being automated away. We did some work on this. The TD Economics group did some work on this a few months ago, where we actually kind of detailed which industries we thought were at greater risk of automation moving forward, or having their jobs kind of taken by machines, quote unquote, moving forward. I unfortunately, like, the exact list is escaping my mind right now, but we have, you know, a report right there that you know, the person that asked the question could refer to sort of, you know, get the information they're looking for.
Interesting. Yeah, and I mean, automation to me, I think is a good thing. It really depends on how the sector takes it. There's lots of criticism about McDonald's automating, but in fact, when you really look at what they did there, they just shifted their workforce to another area to adapt to the differences they were doing in their menu, and they felt that, you know, those mundane order taking tasks could be better served, you know, with higher end products that required more labor. So they shifted. They actually hired more once they put that automation in, and that's it quite often gets thrown under the bus. And I think if industries shift that way, you know, more on the tech side, it's a good thing, really, when you get down to it.
Yeah, I mean, it's you know, it helps with productivity for sure, and, you know, employment, you know, outside of the pandemic and recessions generally goes up, and there's, you know, technological change has been a feature of economies for many years, right? And employment keeps growing in the aggregate, right? So there's always frictions and tensions as people switch, but overall the economy powers forward, right?
Absolutely. So a question here, a little different. Like, goes back to youth, so I guess it's on the same topic line. Are you able to comment on the impact of the youth demographic from the pandemic and reattachment or joining the labor force?
Yeah. So yeah. So the pandemic was quite severe for youth and women, just by the nature of the industries that were impacted. Encouragingly, however, the youth participation rates have come up quite nicely in Canada as you know, as reopening has occurred. However, that's for sort of, if memory serves, that's for really the sort of the younger age group there. The 25 to 29 age bracket is still, you know, struggling a little bit. So the pandemic is still is weighing on outcomes there, and it's causing some people to reassess. You know, you go back to school, you know, retrain and the like. But, you know, other youth have you know, as reopening has occurred, they've done okay. It's been okay for them.
Okay. Question here that I mean, partly me, but I'm also going to throw this at Mike, because we've had several questions about this. What loans are available to small business entrepreneurs? So from the chamber side, you know, the Ontario government has a calculator out where you can pop in your information about your business, and it'll actually drill down and tell you what grants and loans are still available or are out there for business supports. But one of the most commonly kind of neglected thing, I think, is the ability for the banks to loan at some pretty incredible rates. And if you're if you're not looking at your bank, you probably should. So here's your opportunity, Mike.
Thanks. That's great. I did see that question. I was hoping we were going to get to it. So absolutely, as I said before, we are lending at a great pace right now. And what specific loans are available? All of our existing loans that we've had in the past are still available. There hasn't been anything new or specific that have come up. And especially for small businesses, if you're looking at that from startup costs of $0 to $50,000 kind of space, what we really look for is personal credit history, right? So good credit score and then net worth. We don't get too much into a business plan. That's where we partner with the BDC for those larger deals for startups. And in this case, actually, in the past year and a half, we've partnered with the BDC more often than ever before, as they will do part of the financing for the startups, and then we'll come in and do some operating capital as well, operating facilities. So there are available products to entrepreneurs and small businesses, and they range from anywhere from like I said, the 10,000 to 50,000 to more than that. And we look for good credit history, the net worth piece of it, but also a business plan that's going to help them. That they've done the research and they put some time and effort into the business plan. We have a business plan template on our website at td.com. But there's also some really good work that David Hyde does that at the downtown Barrie Economic Center. I know they're specialists in terms of helping putting together some business planning templates. So a shout out to Dave and the work that him and his team does in downtown Barrie. But we are open for business and certainly available for those types of activities.
Yeah, and the other side of that too is that the economic supports that are coming from government are it's a fund drop. It doesn't come with the advice that you're going to get when you get an advisor or somebody that's vested in that loan and seeing your business grow, because they want to see you succeed for many different reasons. So don't rule that out. I think a call to Mike, or any of his team is a good call, because he's a fair guy, and they're not going to steer you the wrong way ultimately. So. So there you go. There's your plug, Mike. I paid you back. All right.
Oh boy, thanks.
There's a couple of interest rate questions in here. What's the downside risk as interest rates globally hit lows?
Okay, so interest rates have started to rebound from their lows recently, but they have been low for a long period of time. And the risk from low interest rates, there's, I would say, I'll point out two. So first of all, when you have low interest rates, certain sectors of the economy take off, like housing, for example, like as we've seen during the pandemic. So what low interest rates can do is they can encourage some people who may not, who under different circumstances wouldn't necessarily qualify for a mortgage. They're now able to qualify. So if you take out a variable rate mortgage, for example, and it's under a low interest rate, and you can qualify for some elevated home price, and your loan to income ratio is extremely high, so you have a lot of debt there, and interest rates start to creep higher, eventually that could kind of cause you some financial stress. So if people do that in the aggregate, then that causes some risk to the overall financial system. So that's one issue. A second issue with really low interest rates from a policymaker's perspective is what happens when there's the next recession. Right, you can't lower interest rates, right? If interest rates are so low, you basically don't have that tool anymore as a policymaker to stimulate the economy, right? So you have to, increasingly rely on other sort of measures, right? So that's one of the reasons why they want to start to normalize the interest rate moving forward, so that they can have it as firepower moving, for the next recession. So when you have interest rates as low as they are, it can encourage some excess risk taking, I'd say, and it can also be a thorn in the side for policymakers to address future recessions. Oh, another point I'll make is that the government, government spending it can be easily financed when interest rates are low, right? So the federal government, and provincial governments around the world are spending a lot of money now to arguably rightfully so. Who knows? I won't get into that, but part of that is because interest rates are so low. So even though their debt is going up, their interest costs as a share of their revenues, for example, are going down. because they locked a lot of that debt into these low interest rates. So the low interest rates can stimulate a lot of spending. In the case of the governments, they may have to start raising taxes moving forward to cover the deficits they've taken on by this spending, right? So there's lots of I would say consequences of low interest rates on the economy.
Yeah, and I mean, typically we don't want to be getting into these high tax rates. It's just, it's
Yeah,
already
yeah.
ridiculous as it is, and that's the worst thing that can happen.
Yeah.
There's a question here from Louise. She asked a question previous to that, and what I'll say is she's asking for other reports and recommendations with regards to the labor market. We'll take that offline, Louise, and you can contact us at the chamber, but we'll put some information in terms of being able to contact these guys and get whatever reports they have available. So, and there's a question in here about the minimum wage. So, and I'll read it verbatim. In your humble opinion, would increasing the minimum wage to 25 per hour fix the staffing issues and incent people back to frontline work, typically paying $15 an hour? Who can survive on this wage and not have it be on the shoulders of taxpayers? Let's get youth and parents back to work, give them the means to work and still makes it possible to pay expenses, rent, mortgage, food, which has all gone up significantly. Obviously, your inflation, but wages haven't increased enough. And I'm hearing this, quite often that, people are leaving these markets, especially in the, as you call them, the soft touch or, markets. Or
high touch industries, right? Restaurants, a lot of face-to-face interaction and all that. Yeah.
Yeah, I mean, if you're working in a kitchen, it's miserable work. I mean, ultimately, even if you're passionate about it, at very low pay, it's not sustainable, and that's why people are, they're like jumping ship left, right, and center because they're trying to find better accommodations. So it's a good point. What would the impact of getting to that kind of a high hourly rate due to the economy?
I think that's a great question. I think we're going there. I don't know if it'll be through minimum wage legislation necessarily, but I think employers, are going to have to start raising wages. I mean, it hasn't permeated fully as yet, but there's momentum building for wages to pick up. So because these labor markets are so tight, that's what people are going to have to do for to sort of attract workers, particularly in these industries where like these high touch industries. The opposite side of that from a business is that if you raise your wage really, really high, you can't then lower it when the pandemic is gone, right? So if you're going to make that decision, then you have to make sure that you can sustain it sort of over the long term. Now, raising the minimum wage, from its current level, was $15 or so an hour, I think now, to $25. That's a huge increase, and that's not like that's. The thing with that is that $25 an hour in Toronto means something different than $25 an hour in Barrie or $25 an hour in London, right? So it's more punitive in places like Barrie and London where where wages are lower on average than a place like Toronto, right? So that's an important consideration. Also, raising it from 15 to 25 is, I don't know what percent increase that is, but that's a massive percent increase in labor costs. Right, so it might help draw some workers to your store, but at the same time your costs are going to go up as a business big time, right? So that's not, and what's the implication of that is that you eat that in your profit margins, or you make a loss, or you pass that on to inflation, right? So that means inflation goes up, right? So this, the policy would be, I'm not sure a minimum wage, like a steep hike in the minimum wage would be the way to go, because once it's there, it then has to be changed by legislation, which takes time. Whereas in a market situation, wages naturally go up because demand is outstripping supply. So the answer here, I think, is if businesses need workers, and obviously we know they do, is for wages to go up naturally as the market would sort of dictate, and that's sort of how you draw the workers in. So I'm not sure I would advocate for a big jump in the minimum wage. I would just sort of let the market do what it needs to do. And there's some evidence there that wages are starting to pick up across businesses.
Yeah, and I imagine if you're forcing down and making things more affordable, downward pressure on the house prices, and there's a question here with regards to that. That makes things more affordable. You don't need those higher hourly wages to be able to live. Same person question with regards to $400,000 or $500,000 mortgage with good money in the bank and good credit, but still declined by the banks. Can you explain why that's happening? I mean, I don't know. I think there's a lot of personal situations that involve that, and I would hazard that we're running into the situation like we were in 2017, where you've got these massive houses going out, and then the bottom falls out, and you're upside down on your house, right? So I think the restrictions that we have in place are there to save you a bit in the long run. But anyways, I'll let you comment on that because I'm not an economist, obviously.
Well, I
Okay.
just wanted to jump in because I
Yeah.
did see that that question, and it's a great question. And like you said, Paul, every situation is different, or every application is different. One of the things that one of the things I would say is the Schedule I banks are regulated in terms of how we can lend, right? And so back 2008, 2007, when we got into that subprime bit of a trouble, banks were lending out, not necessarily Canadian banks, but a lot of the American banks were lending out mortgages with people with no income. So they were lending out $500,000, $600,000, $700,000 mortgages, and people didn't have the income to service the debt. Whereas in Canada, we have to be able to show, whether it's on the personal side or the business side, that you can pay us back, which is not always a bad thing. I know it can get certainly difficult for self-employed or business for self clients. But at the same time, the banks have really tried to get more creative in terms of how we show that. Looking at different financial statements, knowing that business owners are trying to write off as much income as possible to reduce their tax level. So we are getting creative, but at the same time, we are legislated that we have to provide proof, and they audit our files that a customer can pay us back for that type of a mortgage, and based on the outstanding debt, and then those new mortgage payments as well. So, like I said, can't get real specific into the details, but overall, all the banks are legislated by that type of a guideline.
Yeah, absolutely. So we've got about 4 minutes left. So I think we'll ask maybe one more question. A lot of these were kind of answered on the shoulders a little bit here and there. There's one in here about construction, so I think I'll ask it just because that's your mainstay. Mentioned housing and construction activity were down a little. Do you think that this will reflect in housing prices? What might it take to bring housing prices down? I mean, it's a huge. I mean, I had a bit of a windfall this year, but I'm in a position now where trying to find something to buy is a problem. So I'd appreciate it if you can bring our house prices down, so I can stop renting. But
well, yeah, you're not going to like what I have to say, because the only thing that's going to bring house prices down in this environment is a recession that hits homeowners. So this pandemic, or a rapid increase in interest rates, which is probably not going to happen. So the pandemic didn't, like, the people that lost their jobs in the pandemic were younger workers by and large, right? And these workers tend not to be homeowners, nor are they in the market for ownership housing. And in fact, employment outcomes for some industries has strengthened during the pandemic, and there's a lot of homeowners in these industries, right? So this type of recession is not going to do it. It's a recession that needs to hit people with higher incomes, and those recessions are extremely painful. 2008, 2009 was one of those instances, and it took a long time for activity to normalize after that recession. So we don't want, me personally, I mean, I'm not a big fan of nobody's a fan of, not having great affordability or anything like that, but the medicine required to lower home prices is not, or the events required to lower home prices would be extremely painful, I think, for the economy. So unfortunately, I think they're here to stay. And, I think that's a better outcome than having a steep increase in interest rates, for example, or a recession that hits, like global financial crisis or something like that hits people with higher incomes.
Yeah, I think you're right there. I think that the bigger problem is the instability in pricing. A house is listed at X, and then you get into these bidding wars where it goes up exponentially higher. If you know what to hit and what those parameters are, and they're stable, then I think stability in the housing market is what we're looking for more than decrease in prices at the moment. Because I would agree, a recession hurts everybody, not just those that are in a position where they can afford a house. So. Yeah. Anyways, great comments. There's like 8 questions left in here, and I apologize to those that we can't get to. But please, we will have those questions in there. I think we answered the majority of them. If there's anything in there that you really want an answer to, please send something to webinar@Barrie Chamber, and we'll be happy to get those questions in front of our guests today and and get you some answers off camera kind of thing. So with that, I'm going to bring this to sort of conclusion. I'd like to thank you both for coming today. Mike, obviously great working with you every single time. Rishi, nice to meet you. I'm glad you're a resident of Barrie, and it's good to see you up there. You should hopefully maybe try to get up to some of our events at some point. I think your talk today was just fantastic. I'd also like to thank our audience, obviously, for doing everything that they do every day to flatten the curve and to continue to operate. These are very tough circumstances, and we're going to get out of this together. So participating in these events helps to get you educated, and and that's not a bad thing. We've also got a number of other things that are up and coming the next little while. Our rapid screening program is well underway, and it's seeing an increase. We still have lots of supply available, and we're still working on figuring out exactly how long we're going to run this. But for the meantime, we've got lots. So please, if you're interested, it's a great way to make your staff, your customers, and the families of your employees feel better because you're safe. We've got Chamber Chat Networking at noon next week. We'll be hosted by somebody else. I'm on holidays, which is a good thing. But we hope to see you back for that. We have an in-person BA5 being planned as we speak, and we're hoping for October 20th on that. So watch your emails for details. We're just trying to get, obviously getting back into in-person is a bit more complicated than it has been in the past. So we want to make sure that we've got a smooth transition into that, but stay tuned. Accelerate Summit happens October 19th to the 22nd, so the week after next. So tickets are available. Go to acceleratesummit.co. They're very reasonably priced. It's a fantastic event, and there's lots of learning in there. We've got over, I think it's 40 speakers over the 3 days, a number of different events that are going on, sponsored by, or we're presenting partner of that, along with Henry Burnick in the city of Barrie and a number of other organizations in town. So please look into that. And we've also got a local for local online auction coming up. It's a new event, a bit of a fun one. We did a test on this a while back and it was successful, but this is sort of a new way to connect and network and look at a different way to do business. So watch for details on that coming soon. And also stay tuned for an announcement very shortly on a shop local program that we are getting involved in or actually leading in the community. And that's going to be a great way to get people focused on shopping local and why shopping local is so important. So that should be out hopefully by the end of the week and early next week, and you'll start seeing a lot of that stuff in the community as you drive around. So with that, I'll say have a great day, have a great rest of your week and weekend, and I'll see you in a couple of weeks. Thanks a lot.
Take care, everyone. Thank you.
Thank you.
Thank you.